Right, yes. Hello, everybody. So it's Richard Little, your land partner. Today, I want to talk about market conditions and the importance of them in the life cycle of a development business, I guess. It's quite interesting, really, because one of the things I hear a lot about is market conditions is respect of well, we don't know. It's uncertain times at the moment, and that could be a pandemic, which makes times very uncertain. It could be maybe an election, a Brexit, all of that sort of things. It's quite amusing, really, for me, because I've been around 40 odd years in this business. Development is an uncertain business. It doesn't matter where we are. It's always uncertain because the timeline of most development projects, even if you've got something we're planning, is still a year, 2 years, maybe even longer before you come out the other side, depending on the size of the project. And if you've got planning, we've got one recently. We'll be probably 6 years before we come out the other side, and that's not necessarily that unusual. And if we're going into a deal and we're not going to come out for 6 years, nobody can predict what the market is going to do in 5 or 6 years. And in times of extreme uncertainty, when we know that perhaps we've had an economic situation and perhaps money's getting tighter, affordability issues, unemployment, etc. So the values might be coming down or might have come down quite a bit. Then we know that okay, in a month's time or 2 months' time or 3 months' time, it's probably not going to be massively different. So market conditions, about what people do is they take what the conditions are today, and what they're really trying to do is predict what they're going to be in 6 months, 12 months, 6 years, as my previous example. So how do we look at that? Well, obviously, if you're looking at an opportunity and you're trying to make that into a deal, whether you're working with landowners, equity partners, whoever it might be, we have got to do some sort of prediction. We have got to, because otherwise, what do we base our numbers on? Well, generally, what we will start at is what the current value would be of a given development. Once it's complete, as of today. Well, obviously it's not complete today, but it's today's value that we use as a bit of a benchmark. Then what we look at is what is the trend. So what I mean by that is, our price is going up or our price is going down. But when you look into trend, it's a little bit more than that. So we could be in a rising market, and prices perhaps on average, say, are going up 2-3% a year or whatever. But it's year on year. Are they rising slower than they were the previous year? So from, say, if we were in May, you go from this May to last May, what was the state of the market then? What had been, where was it at? What is the difference between now and then? And what is it like to previous year on year? So we always go year on year because there's a lot of seasonality in the real estate sector. Certainly when you are looking at selling your project, your product, your properties, and there are typically certain times of the year where it's better to be selling, and others where it's better to avoid. That has to an extent changed considerably over the last few years, but it's still there. So we look at year-on-year trends, and we look at those, and we can look at those in terms of, a year, 5 years, etc. I mean, most people are aware of cycles, the economic cycle, and I hear all sorts of things, prices double in 9 years or 18 years, or when the cycle is 9 years, 8 years. And there are a certain number of patterns that can actually, for those of you who are interested in it, there are a certain number of patterns that can be quite distinctly seen from the last war, the Second World War. So what we're looking at 75 years ago. But actually, you know, equally, that is a relatively short period of time to actually draw massive conclusions like there's something happens every 18 years, because it will have only happened 3 times or whatever in that period. So we do look at trends, we do look at history. We are looking at it not necessarily to predict the future, but we learn a lot from the past. So in terms of market conditions, what they are today is not what they will be in 3 months. And when we are in particularly uncertain times, which, you know, one could say right at this moment in time it's uncertain, but it genuinely is at any point. You know, it's uncertain. So how do we predict that? So we look at trends, we look at current market values, and then we look at the trends. Are we still expecting growth? So fairly recently, I saw a report from Knight Frank and Savills, I think, that were predicting a fall in market value, market values of 3.5%, 4% over a period, and then it picking up again over the next year. So within 20 months or so, it was going to go down and come back. So it would be at where we are now. Well, for some projects, you know, that would be about right. But of course, are they going to be right? You are basing a deal and a deal structure and an offer on forecasting. Effectively, it's a crystal ball. And one of the keys for a developer is actually, you know, having the, what am I going to say? Right, they're having the willingness to spend the time to look at what has gone on in the past to help them guide what may happen in the future. I hear a lot talked about gut instinct and gut feel and all this sort of stuff, and actually it's very, very important part of a developer's sort of makeup. However, you have to do all the work before you decide using the gut is the right thing to do. So I'm not really going to talk about that too much today. That will be a whole episode, I think, at some other point. But taking existing values and building a deal structure based on that. If we are looking like we are in for a period of, perhaps we've been in a growth period and we're now looking at perhaps either, you know, staying steady or maybe slipping back a bit or even a lot. So we will look at that. We will use some sensitivity analysis, and we'll sort of say, right, okay, what happens if those end values are 10%, 20%, you know, back on that? We generally don't go much more than 20%, but we will look at it and we will take it and we will play the what if game, as I call it. So play around with a spreadsheet and spend, you know, many happy hours sort of doing that, looking at the project. So what if the costs go up? What if the value goes down? And you get a better understanding of where that project is, how sound that project is, and the structure then gets built around a value. Now, if we build it around today's value, then that's okay if the market rises or stays the same. But if we build it around today's value and then it slips, then we're going to be into trouble, aren't we? Yeah, that makes sense, you know. And you know, but constantly I see people offering on today's values, plus they think it's going to go up. Somebody said it's forecast it's going to go 3% up, it's going to go 5% up. They'll build it into their numbers. And it's not just small, medium-sized and inexperienced developers that do this. Some of the big guys do that. Yeah. So, you know, people do overpay, they do overvalue. And we get drawn in, or we can easily get drawn into that. Oh, we need to pay more because somebody else is paying more. And if somebody else is paying more, it must be worth it. Well, actually, they've got no more idea than you or I whether the market's going to go up or down. You know, even in a period of definite issue like, you know, Brexit in the UK, there was Brexit and the forecasts were from cataclysmic to, no, it'll be fine, it might even improve the market. And nobody really knows, and just because somebody shouts loud about it doesn't mean to say that their view is more valid. It just isn't. So one of the key skills you will need to develop to become a developer is when you act on your instinct, when you act on your gut, and how much you take store in what the market is telling you or what you're seeing in the market. And that's two completely different things. We know whether the amount of information that's around these days, we know that we can find something that will back up our view, whether it's optimistic or pessimistic. We will always find something, and there will always be an expert that will give an opinion. So if you're looking for it, if you're looking for somebody to say, oh, the market's going to grow in a particular area 10%, then yeah, great, you'll find something. And equally, if you'll more likely find some miserable old so-and-so like me that will probably be a little bit more cautious and say, oh, well, the market might shrink 10%. Well, most people won't listen to me until we get into times of uncertainty, and then they sort of say, oh, yeah, you might have been right, etc., etc. So market conditions are really, really key, but please don't fall into the trap of actually saying whatever the market conditions are now, that'll be fine. I'll base the deal structure. It's probably going to go up because do you know what? This development's in a great area, always goes up in this area. And there are certain areas in the country and certain development types and sizes and styles that will not be affected as much by a loss, and equally there are some the same that won't be affected so much by a rise. So you've got to take a really balanced view. Some parts of the country will be shielded from huge losses and some will be shielded from huge gains, you know. So it's knowing an area, so it's not just knowing the market, it's knowing the local market. But please, please, please don't make the mistakes of thinking you know the local market and actually it will be exempt from major economic issues. Like if we go into recession at any point, and when we do have a recession, that market will be impacted. So it's taking market conditions and looking at projects that may fit where we feel the market might be going. So the safest thing over the 40 odd years we've been developing is what we call building boxes. So building houses, building 2 and 3 bedroom homes, 3-4 bedroom homes for families and couples, because the bread and butter in most areas, they're not of significant value. They will rent, they will give a return if you can't sell. So the other thing that we need to consider with market conditions is what's our exit strategy. So market conditions don't necessarily matter so much if you are developing or purchasing to hold and you are going to do that for a long period. As long as it stacks up, you've got the cash that you need, you've got the borrowing available, and it's not going to be, you know, too stretchy in terms of loan to value, then do market conditions really count? Well, maybe not so much, do they? Because, you know, a lot of people say, you know, you buy a property and you wait. You know, so it doesn't really matter what you buy at. Well, actually, to be fair, that's not always the case. You know, we should be fully aware of changes to the way that people live as well. So, you know, I don't know, over investing in either purchasing or developing and holding, you know, 1-bedroom apartments in some areas might be fantastic. In other areas, might be the wrong thing to do. So it's being aware all of the time. So understanding, you know, what's going on in a given area in a market, not the general market, not even the value, but the type of property. You know, is there too many of this? And I always pick on apartments to say that there's many areas that we're familiar with where there are just too many apartments built. And there are many more of those that are either empty or gone for rent because they couldn't sell. You know, so over concentration is a really big thing. You know, so we need to be really familiar with that. So I think just sort of, you know, I could talk about market conditions forever really, but I think the key points here is, you know, knowing the market history. No, in a given area, national averages don't mean anything. Regional averages don't mean anything. It's, you know, what is the market conditions, the market values, what's the history of those in that street sometimes and that side of the street sometimes, not just a postcode or anything like that. So, you know, do your research when you're looking at an opportunity and you're getting to the point that, oh, this might be a deal, we're getting around to perhaps making an offer or whatever. Let's really look into, you know, what the market may be doing and you know, where we feel it might be going in the future. Don't rely on gut. Yeah, gut is important, but don't rely on it as your first instinct. Generally, the people that do that, they get burnt. Yeah, you can't get through on luck, on gut. Freudian slip there. I said luck. Actually, whatever you do, you need a little bit of luck in development, and particularly from the point of view of where the market's going to go. I don't know where the market's going to go in the next 6 months. I don't know where it's going to go in the next 2 years. What we always do, come back, do your sensitivity analysis, look at it and sort of say, right, okay, if there is a shift in value of up to, ordinarily 10%, but in exceptional times we do 20%, because we've seen bigger reductions in that short term, a number of times previously. So, just do your homework, and if you're not sure, talk to somebody else. Sort of say, does this make sense? This is my thinking. I think the market's going to go this way. But do not just go on price alone. Look at what sort of development you're going to put. What sort of units? Do they fit the market now? Okay, fine. Will they fit the market in 10 years if you're going to hold them? Or how adaptable are they? Can they be converted? Can they be doing, something else? What is now, perhaps an office block could quite easily be, apartments in a few years' time, and it can go the other way as well, which we've seen over the last couple of years in a couple of areas. So it isn't just about the number. Market conditions also have to be about the demand. Yeah, so what is the demand going to be? So anybody that can predict the demand, great. You're going to be, you're going to be in front of everybody else. So that's again where we look at trends, in terms of demand. What are people now buying that they weren't buying before? What are people renting now that they weren't renting before? So there's an element of availability, supply and demand, etc. But we are changing the way that we live. So just think about that if you're looking at developing, particularly to hold, because you might develop something that maybe hasn't got enough open space, so too cramped. I see this with a lot of conversions. Yeah, okay, gonna do this, and we're gonna get minimum space standards, etc., or even lower than space standard on prior approval. And it might look all right now. I can guarantee it won't look all right in 5 years and 3 years and 10 years when it's very, very tired. And if you're holding that could be a real problem for you. So I hope I haven't confused you too much. So the general point of today is about market trends and what to look at. Just remember, the market is always volatile. Sometimes it's more volatile than others, but you have to sort of say that if you're in the development business, unless you are the lucky person that owns a crystal ball, it's a little bit like fingers crossed. So I've been Richard Little. Hopefully you've got something out of that. Any questions or whatever, get them on the thread. We'll do the best to answer them, and some of the other people in the group, a lot of experience in the group that's on Facebook anyway. I'll see you again another day. Bye.